SaaS is dead. And I think that's a fun one because I think SaaS is very dead. We talked to Bill McDermott at ServiceNow 2 weeks ago. We've talked to a couple people in that space where being a SaaS company is now having the nicest house in the worst neighborhood.
Welcome everyone to episode 2 of season 2 of Investing with the Boys. We got all three of your boys over here again. We got Logical, Shy, and we got Sam, myself, here for the second episode kickoff. And I'm going to just jump right into it. It's been a crazy week, 2 weeks with earnings. We've seen crazy moves and volatility from both ends. Very popular retail stocks making big moves up and down. The one that really stands out to me out of all of them, especially with the recent news and the recent moves it's had, I mean, the last month, the thing was like up 20%, down 20%, whatever, is Hims and Hers. This stock, it's actually really interesting on the most recent earnings is that it was the first quarterly revenue miss on analyst expectations. But on top of that, it hit basically a new all-time high intraday last Monday. And then it went all the way down to $52. And then it recovered that. And then it gave that all back after Novo Nordisk came out with the news that they opened up litigation cases toward a lot of telehealth companies. I know we have a lot to talk about this one, so let's just get right into it. Shy, what are your thoughts on the earnings and what are your thoughts on the company moving forward?
So if you're a Hims and Her investor, it's not for the faint of heart. You got to know it's probably the most volatile stock that I track out there. And this is coming from a RKLB, IonQ shareholder, etc. I think there's two ways of looking at Hims right now. And both are true. On one hand, you have the business, I think, was growing 70 or 75% top line. I think their adjusted EBITDA is expanding at over 100%. They're adding subscribers at scale in a market that kind of has failed. Incumbents have failed to disrupt. That's like clear business execution. They're doing a great job at that front. And it's also not coming from these like loss leading pricing, fugazi type stuff or one-time pops. Like, I'm pretty sure the average subscriber, the spending is like $74 a month. I think that was like 30% increase year over year. So like the platform has proven that it can drive sustained engagement through personalization. Like that's their whole thing. It's not going to be just this commoditization prescription delivery system. But this drop is justified because I do believe this is the first real stumble as a public company, and it wasn't just a revenue miss, it was a sequential decline in revenue and margin compression kind of happening at the same time at a time when the business is supposed to be scaling. So there is somewhat of a perfect storm of, on paper it looks a little off. The street was pricing in the transitioning away from the compound GLP-1s that would be a lot more smoother than it actually was, and they thought that the core business would be picking up the slack and that Hims would be continuing their compounding like they've done like clockwork. But I think this earnings report proved that it's going to be a lot messier than anticipated. So you have to revise the expectations. And the GLP-1 alone went down 20% quarter to quarter. That's a huge pullback. And that was their biggest growth engine last year. I know this is not a GLP-1 business, but it's still a anchor on what the stock is going to do going forward because it has that transition phase right now. Yes, they reaffirmed their weight loss revenue guide, but now that the target assumes a sharp reacceleration in Q4, I believe, and that is a high bar to pass because there is no room for further slippage. So meanwhile, I think the rest of the business, the sexual health, the dermatology, the mental health, they actually all went flat or declined sequentially as well once you stripped out to GLP-1. So there is somewhat of a high expectations and potential problem if they don't hit their full year guide. And the fact that the average revenue per subscriber also fell $10 quarter to quarter, despite I think Hims positioning themselves in the high ACV part of their platform. Essentially, this is a long-winded answer saying there is a lot in flux right now, and especially in a highly commoditized like space like telehealth, like when you have Novo Nordisk suing you, and you have like this commodity, your industry is a commodity narrative, and these are the fundamentals you reported. Like it's kind of a very noisy situation, especially the run-up it's had this year. That it feels like there needs to be a digestion period. I don't think it's going to go in the 20s. I'm not saying that. I just think it's $50 looks like a very clear floor until they can like iron out what's happening with the business. But I don't know. What do you guys think? Do you have any other inputs on that? What to do with HIMS?
So, I mean, $50 as a floor would be today, as of our recording on Wednesday. That it's dropped pretty considerably and been extremely volatile. I mean, I've been investing in him since the high teens, not even for that long, which is really interesting because it's had so many ups and downs, and it can be pretty advantageous for a lot of traders in the market. And this is a trader stock. It has very high premiums. A lot of people do practice selling covered calls and so on. But going back to the fundamentals, I think that ever since their relationship and partnership with Novo Nordisk did break off, and all the allegations that they put out there, which is of course what they're going to do in their own best interests. And then we heard that Novo Nordisk is opening, I think it was 14 cases with telehealth companies. They didn't specifically name HIMS per se, but it was almost like they said, we're going to sue 14 telehealth companies. We're going to open 14 cases, and they're going to be targeted toward companies that rhymes with BIMs and BRs, right? Like, it's obviously for HIMS. And it was actually pretty interesting because there's another telehealth company out there, much smaller cap company called LifeMD, where they do focus more on the telehealth sector. And then there's also a business that they do consume on top of that, which is included in the metrics. They just reported earnings after hours yesterday. Didn't get to dig into it too much, but the stock is down 45% today. It made its all-time high around $15, and it's dropped nearly 58% from that all-time high. And this was another telehealth stock that was also running hot in addition to HIMS. So I would really attribute this to not just the fact that HIMS being a growth stock, of course, with being an online pharmacy for a lot of generic branding medication, also with the generic branding or compounded semaglutide, but also the fact that the entire sector in terms of tech, when it comes to disruptors in Medicare, not Medicare, but when it comes to disruptors in pharmaceutical products as well as online medical professional assistants, they all got hit. And we all know the whole story with United Health. There is a bigger narrative going on here that's hitting healthcare stocks all across the board, whether they're generational disruptive healthcare companies or where they're legacy conglomerates like United Health and so on. They're all taking a hit across the board. And I think there's an underlying macro reason for all that happening, which I believe is starting to come to fruition. But the fact that you have leaders in semaglutide out there. Of course, you had Ozempic and you had Wegovy from Novo Nordisk starting to stir up that drama in the whole situation. It does make investors a little bit uneasy in the scenario. However, I look at the quarter. I'm looking at it with with probably a little bit more optimistic in that sense, mostly because I am biased in the situation. But I mean, they did grow subscribers by 73,000 quarter over quarter, and they had some good numbers as far as the segmental metrics. But yeah, I think missing that revenue expectation for the first quarter ever was probably a big thing to kind of put like investors and the momentum itself at like a standhold. Because now it's like, hold on a second. Is this like the leader that we're all expecting, or are they going to run into a little bit of a digestive period, which you're saying, which I do think they will. The thing is that as far as the market goes and as far as we goes as fundamental investors, this is a trader stock, man. Like, they can bring this thing all the way down to $30 and bring it right back up to $70 at the very next day. You do need that stomach to own this stock. In fact, I would always attribute that, and I think Logical will agree me on with this, is that you need to have the position sizing when it comes to something like this. There are people who are like 100% invest in their portfolio in HIMS. Great, you have that conviction. Go ahead, do what you got to do. But for people who want a diversified portfolio, being in the leaders of the entire world, it's so difficult to put that much leverage on this company as far as concentration of portfolio risk goes.
Well, I also want to add, this isn't a broken business. We're talking about HIMS being a business in transition right now, where their GLP-1 business is completely unpredictable. It's obviously eroding and it's transitioning that self out. It's just at the same time of that flux, their core business is also losing momentum at the worst possible time. And just as they're trying to ramp up marketing, capex, headcounts, but they are launching some really exciting things. Like, they are expanding into hormonal health, which is a really big market. I think they're layering in diagnostics with lab testing. They're launching AI agents. Like, this is an agentic AI play. They are pushing into international markets like Canada and the EU, and also Latin America. I'm pretty sure they announced, and Asia. Like they are going global, and they're not just trying to sell more pills. They're not like a pharmacy. They're trying to build a vertically integrated consumer healthcare platform, one where a customer starts with hair loss or acne and ends up with personalized wellness membership that spans across so many different lanes, like diagnostics, treatment, prevention. Like it's they're really trying to disrupt a massive industry. It's just this is their first speed bump as they're scaling up, and I think it's going to be okay. Like you can't just go vertical. But anyway, I do want to pass it to you, Logical, on position sizing, because I think a lot of people were very over indexed on HIMS in their portfolio because it just ran up. They did no trimming, and now they're really feeling this pain from this temporary bump. How's the portfolio management going on your end? Because I know this is a very important earnings week for you. There's a lot of names for all of us. How do you like manage that?
Yeah, let me real quick before I go to portfolio management, let me give a comment on the HIMS topic. I think the elephant in the room is that they declined quarter over quarter on revenues. This is a growth stock. You can't do that. And if you do that, you get crushed. And I think something that people don't really appreciate in a business like this is, I know I'm going to get a lot of hate for this, but it's kind of a commodity business, right? I mean, they don't have any product themselves. They're just a distributor of a product. There could be other entrants. People have always downplayed that Amazon risk of getting into the market. But the truth of the matter is, I mean, someone could. They have good branding. I will give them that. But I know a lot of doctors that are, doing this on the side where they're, building up these side businesses where, you can go to them for prescriptions without having to go to your primary care doctor just to get something a little bit more conveniently. And the bear case has always been, look, I think that core business revenues outside of GLP-1s have actually been stagnant. And I think you're probably starting to see that in the business right now. So that's kind of where I'm kind of seeing this right now is revenues are declining. A lot of the explosive growth was probably on the GLP-1 side. Perhaps that's still going, but that revenue is at risk right now with all these ongoing lawsuits. You don't want somebody like Novo Nordisk who tried to be buddy-buddy with you. You kind of stepped on their toes, and now they're livid. And they have the IP and the patents to go to court. So, I mean, I would just say that there's going to be a lot of lobbying against you as a compounder. Whatever that ends up being, I don't know if investors are going to sit still and watch this company, which, it's not that expensive given the growth, but people don't care about growth as a velocity. They care about it from an acceleration standpoint. Everyone only cares about growth businesses in terms of the second derivative. What that means is growth accelerating or decelerating? And right now, growth is decelerating. So that's going to chop that multiple, especially on a business where I know they talk about, oh, this is a 76% gross margin business. But the truth of the matter is their operating expenses are extremely bloated. The sales and marketing line item has always been high. So I don't want to say artificially, but in a sense, like the gross margins are high, but the operating margins have never been that high. Adjusted EBITDA obviously looks good. SBC is pretty high, so that's getting adjusted back. I don't know. It's one of those things. It was always going to be musical chairs at some point, and a lot of these growth stocks, besides maybe a Palantir, which can keep defying the impossible, a lot of these end up having a day like this. And I'm not sure where the stock nets out, but I would just say that potentially like some of these other growth names have something that's a little bit more durable from a growth standpoint. So that's my thoughts on HIMS. Let me quickly touch on portfolio management because I think it's really important. People love a bull market. People love high beta stocks. People love it when their stocks go up. But the reality is that at some point, it is like musical chairs, or there are going to be pauses at the very minimum. And what a pause could look like is, hey, like this stock is up 100, 200, 300% in the last 1 to 2 years. I mean, that's beating the market on like a 10-year time frame in, a year or so. I mean, you've pulled forward a ton of those returns. And, maybe a lot of that's been alpha, but probably a lot of it is attributable to beta, which means that there have been people who have been chasing the stock on these great results. What happens something that people need to understand is that when you have price, it determines the market cap of a stock. When you have a market cap of a stock, that's what you use to determine its valuation. Whenever a stock has very high positive sentiment, people chase that stock up in price. The price means that the multiple is expanding, the valuation is getting more expensive, which means that the expectations got a lot higher. For me personally, I understand there's a lot of people who can do really well chasing, what's been working. But when it gets to a point where the price is really high, then it's really tough to keep beating expectations and going up higher. So that's one thing I would say from an expectation standpoint. That's why I personally try to shop in areas that have somewhat lower valuations that I can feel a little bit more comfortable in. And I know this is a whole topic on its own. Shai puts valuation in the backseat. Totally get it. But he does pick best of breed companies which are able to defy those odds. So you can do it. It's just a lot harder, I would say, to pick true quality. And, I don't know, is this going to be the first indication that HIMS is really not that high quality of a stock? We'll have to see. In terms of position sizing, and then we can move on to the next topic. When you're dealing with small caps or high beta stocks, things that are very volatile, something that people don't understand is that these small caps, high beta, they move so much, 5-10% a day. They're not 1-2%. We're talking no news. These things move like options on large caps. And so when you realize that, then you have to understand, for your own sake of not having a heart attack every day, it's probably best to size it in a way where a 5-10% move on a daily basis doesn't kill you. And you can end up holding through that volatility with conviction. So volatility is the price you pay to have high returns on the upside, especially with these volatile stocks. And guess what? High upside means there could also be significant downside. And so to that, I would say, look, a lot of my positions, I hold at around 4-5%. Why is that? If I go into earnings with a 4 or 5, let's just say a 5% position, let's keep the numbers easy. 5% position, it's down 20% on earnings. That's a 1% hit to my portfolio. I'll be fine. But when people come into these earnings and they're, sizing these things at 10, 20, God forbid, 40% or whatever they're doing, and then they have potentially calls on top of that, weekly ones with high IV. I mean, you're just asking for it. And, so I would just say, when you're dealing with high beta stocks, you're dealing with things that are, more volatile in nature, the best thing to do, and I get laughed at about this because people say, oh, you're never going to get rich with, concentration, or without concentration, you can't do diversification. The truth is that when it comes to small caps and high beta, a small position is enough to have significant upside. And a small position is also enough where if it implodes on you, you'll be very happy with that small size. So I think small size is, kind of underrated when it comes to these high beta volatility stocks. Yeah.
I want to add some color to that because it's a great topic, especially when the market's at all-time high. So I'm sure there's some over-index positions for a lot of people on how do I maneuver this? Anecdotal evidence. I'll give you all of them. So Palantir, 2% position when I started at under $10. What's that right now? 180. Freaking nuts. I've don't own the same amount of shares I did under $10 that I do now. I wish I did, but it's risk management. It's been overvalued since the 40s, to be honest. And I think now there's validating their presence in stage 2 AI, but I sold half my position at $50 to $60. I have not touched it since. Even though I think it's very expensive, why haven't I? I de-risked my position. I sold my initial risk. I'm letting the profits ride until thesis breaks. We'll see where the market takes it. And that's what happened. Same thing with RKLB. I got over indexed under $4. I could have, again, 10x. I sold half in the 20s. And now I was letting the rest ride until thesis breaks. So Palantir is still my top position. I've trimmed along the way. I took the profit out, reallocated it elsewhere. But I'm just going to let the winners keep winning. Same with RKLB. But RKLB is an interesting one because RKLB has proved my thesis that they're going to be a full-end space prime. And they didn't really do that on the initial pop as much. Now there's you're seeing their services, there's so many hot pockets in their business where I actually kind of want to add more RKLB now, where I sold in the early 20s. I'd actually probably would love to buy those same shares back. So that's it didn't work that time. But either way, if you have anxiety right now, and it's a multi-bagger, there's no shame in de-risking original position, original capital, and just letting the profits ride and compound. And I want to get to Palantir's earnings, but I think, Sam, any comments on position sizing before I do?
I mean, You have to practice risk management, and that goes for downside and also upside, like you were saying. I mean, Astera Labs, I'm really happy that it basically tripled since the bottom last April, as we were talking about earlier. And it was actually a decent sized position for me near the bottom. So my cost basis was like around 3% of my portfolio. And then when it ran up all the way to $100, since I was adding on the way down, I trimmed probably I think like 30% of my position. And I've just basically let the rest ride. And I've considered trimming over here, but it's just, you know, at this point, around 3 to 4% of my portfolio, I feel like I'm just going to leave it. And the research that you guys come out with in future equities, totally agree with all of it. It just seems like now I don't want to say we're getting started on the narrative per se, but it just seems like since we're very early when it comes to AI, in my opinion, and when you think about the bottlenecks that come in with network throughput, with a lot of inference queries that are running, I can't, unless I'm like trading around the position. Yeah, go ahead.
For the audience, network throughput, what's your interpretation for that? For me, it's just data moving between memory and it's just latency speed, but it's described to everyone else in
that would be
simpler
latency
mode.
speed. So you have the homes, I would say, as far as the individual servers in an environment, and then you have the data that runs through them, right? Through the servers, whether it's network cables, whether it's retimers, or whatever it is that Astera Lab has. And that's where their mode is, right? They have the components that are used to build these GPUs and GPUs clusters, but they also have the retimers that are used to basically increase the speed or reaccelerate the speed that these data packets are running through the system. So think of that as the highway, right? You have the highway, which is the wires, the physical wires, or which is the wireless signals that run between each one of these units. But then you need these retimers in order to reaccelerate or give it that little boost to be able to make it as fast as possible to the other end or to the host, to the destination as soon as possible. And that's what happens with inference, is that someone's sitting on their phone and they let's say they're using ChatGPT. They ask ChatGPT a question where the information already exists in their database or in their LLM, but they kind of need to work with the existing data that you do have on the already trained model. So instead of training, we're thinking inference, and that information needs to go back and forth between ChatGPT as well as the phone itself, as well as other parts of the database that need to hit. That is inference. That's how inference works. You're not teaching the model how to speak. You're asking the model to translate something for you. And that is what matters in all this, because go ahead. Sorry.
No, I was going to say, so to add more color, AI is intelligence. We can all agree AI just is intelligence. That's why it feels like there's going to be an indefinite demand for all this AI thing, because it's not a product launch. It's a characteristic change on the society. Who knows the ceiling on that? Inference is the tax on AI. It's as simple as that. So like what Sam was saying, ChatGPT inquiries or every AI workload, it's inference, the tax you have to pay to use AI. That's why Broadcom is probably the most quiet $1 trillion company in the world that nobody realizes, because they are Uncle Sam of AI. They collect the tax on everyone's AI workload through networking. Astera Labs essentially is, I'm trying to think of a better term, like the toll booth, for example. Like what's that phrase in the California highways where you go on a toll? Anyway, it's a toll booth. You go on a highway, you have to pay. No, I'm saying
not a
for
freeway,
the audience,
but a highway. Yeah.
No, there's like a specific fast section on the highway that you can pay. It's like a
express
toll
lane.
road. I guess it's just express lane or a toll road, whatever it might be. Broadcom essentially allows every single car on that highway to go through their toll booth. They'll collect tax on every single one. Astera Labs is hyper specific to the AI bottleneck that's happening right now. The Ferraris out there that just will go on that one lane and just go from point A to point B super quickly. That's why Astera Labs is kind of a derivative play on this networking theme where Broadcom is the king, absolute king. Astera Labs is just the purest form of capitalizing on what's making Broadcom do so well right now. And the only issue, though, I'm curious on your input on this, Sam, is we all know what happened in Confluent last week. Maybe we didn't talk about it. We won't get into it, but the AI tsunami that I constantly talk about, it happened to Confluent last week, the first glimpses of it, where their biggest one of the biggest customer, maybe the biggest, I don't know, OpenAI dropped them, essentially. They're going to use their open source, create their own in-house competing product for streaming data. And they're like, why should we pay for you when you have an incredible open source product? We'll create our own AI agent solution to compete with your managed services, and we'll be done with you. I feel like Astera Labs is somewhat of a risk for NVIDIA to stop being buddies with Astera Lab if they get big enough. And that's always a worry because they're so reliant on NVIDIA right now that if Astera Labs becomes like a 50 billion, 100 billion company, you never know when NVIDIA will just create their own competing product and cut them off on any kind of NV linked derivative. Like, do you think that's a risk at all for Astera Labs, or am I just being too paranoid?
I feel like it's very different. I mean, obviously, when we get to valuations that Astera Labs is trading at, it can become very sensitive to any type of negative news that comes out, since everything is just good news. It's all balloons, parties everywhere for Astera Labs. Every Wall Street analyst is probably very excited and hiking the price targets as they always do for Wall Street, because they always chase up and they always chase down, sort of. So yeah, I mean, I wouldn't be surprised if Astera Labs comes back and visits like the $100 mark, where it found a lot of resistance before. But from a fundamental perspective, Confluence is software. It's the stickiness of software products is a lot more impactful as far as budgeting goes, as far as headcount goes, and scale wise, than changing your hardware, right? Especially a critical component that Astera Labs does offer. In order to change that out, you'd either need to build it in-house, or you'd either need to outsource it to a different company, right? So let's just say that there is no other company that does it, and there likely is not another company that does it as good as Astera Labs, as we know of right now. NVIDIA would have to do it in-house. Now, if NVIDIA were to have to do it in-house, we're talking about architecting and designing a completely different component that they used to outsource. I think we would probably have wind of that ahead of time. And if that were to happen ahead of time, I think Astera Labs probably knows that, as far as management goes, that they're trying to diversify where their income flows and clients are, which they have already been doing. But also on top of that, like I was saying, was that switching from Confluent to building your own in-house platform as far as data streaming goes is something very easy to do for a lot of companies, especially when you have billion-dollar engineers that Sam Altman has said that they didn't go to Meta, they ended up staying there, and so on. But also, a lot of companies like Meta as well, they don't really buy too many vanilla products or off-the-shelf products. They build their own concept. They basically fork a branch of whatever they're trying to do, and they just build it in-house, start distributing it in-house. They save a lot of costs in doing that. To do that with software, especially with Confluent, which Jay Krebs, who's one of the founders of Kafka itself, it could be easy to do that for them. And they probably were working on it for years, and they finally figured out a way, hey, we don't need to use Confluent anymore, so they would just drop them for that. This could be happening. It's actually very interesting, because we were talking about this before with Datadog, right? Datadog could be in the same situation. Datadog is not an open source platform, but there are a multitude amount of software platforms in terms of monitoring security, whatever it is, including Prometheus as far as visualizing graphics, also Grafana as well. Grafana is open source. And a lot of these hyperscalers offer their own platforms as far as CloudWatch for AWS. In fact, I would even say firsthand,
not just them, though. Cybersecurity too. A lot of cybersecurity platforms have observability.
So it's easy to switch off of software. It takes a little bit of effort, takes a little budget switching, maybe recode some of your applications for the dependencies and everything, whatever. But to switch a component, a critical component in GPUs that you're trying to meet demand with building a lot of supply ahead of time and still being short the supply, that would be a very ballsy move for NVIDIA to do, even Jensen Huang. Maybe with NVLink, that was something possible. That's something that they've always been working on. They came out with NVLink Fusion. So then that way people will stay within their ecosystem, their GPU clusters, by offering compatibility for other GPUs offered by other companies, including TPUs and so on. But to do that with Astera Labs,
they partner with Astera Labs for that. So like they know how valuable Astera Labs Scorpio is, that they're just going to partner up with them, which is a great stamp of approval. But when that was announced, by the way, Astera Labs is in the 60s, I think, or 70s. Crazy
and
opportunity.
It didn't really react like it. That was some time ago. And also, like, they went below their IPO price, which a lot of people were saying, like, oh, if I bought an IPO, whatever, and people had the opportunity, they didn't take it, right? So, I'm not saying that's the only missed opportunity on the market, but when we think about just the opportunity that's been presented 3 months ago versus today, there's not a lot of opportunity today. I mean, I obviously there's a lot of smaller caps and mid cap stocks that do have a lot of opportunity, which Logical's been taking advantage of a lot lately and has been seeing a lot of upside on. But as far as like mega caps, like well known brands that a lot of people know, like a
Well-
lot of those opportunities are really just gone.
Well, you brought up a great point. What's the next opportunity? And I think Logical and I both share one name on where that opportunity is, and it's going through a re-rating. And this week's earnings proved that. I'm gonna let Logical take it, and I'll add on, finish off my thesis on them.
Hold on.
It's
Are we talking about DigitalOcean?
yeah, we are. We're swimming in DigitalOcean.
I'm sorry, but I already told you I cut it today.
I know. But
It's probably a mistake.
you got
There's
the
probably-
post earnings gap. You had the setup, but you got the 30% move. What
I got the
attracted
30%
you? Yeah.
What attracted me to it? It's always been an interesting one in the compute space. It just kind of operates where the other ones don't. And the valuation always looks so good. I mean, for me, look, I've been having a little bit more of my trader hat on, and I noticed that, this thing is basically trading near its lows of the range. Valuation looked very reasonable. The reason why I was alerted to the stock is because I saw a lot of bullish options flow come in. And I revisited the name, and it made a ton of sense. And so I just took a position. And it's a name that I always wanted to own, and we've talked about a lot. But it was back to a point where it made a lot of sense ahead of earnings, and it worked out really well. But honestly, you're the expert on the name, so I'll let you talk about it.
Okay, yeah, I'll add some color. And how dare you portray me? We might have a new co-host, guys, next week.
Honestly,
how dare you?
Believe me, it was a mistake. It was a mistake to cut it. I'll say that right now. It is going higher. I can feel it in my bones, and it was just portfolio management strictly, not anything against DigitalOcean. Yeah,
all good. Yeah, I mean, I've been in DigitalOcean for far longer than I want to admit. It's definitely been not the best stock to own, but I did double my position in DigitalOcean the past couple months because, like what Sam was saying, the winners, the proven winners, have gone through that multiple expansion opportunity already. So it's becoming more and more expensive to own the no-brainers. So if you have capital coming in every single month, it's not wise to continue adding to the proven winners at this current multiple. You have to look elsewhere. What's the next opportunity? Cloud computing was on fire this cycle. You got it from Azure. You got it from Google Cloud. AWS is still really, really doing well. Like they exceed expectations. They had the head of AWS completely messed up a couple years ago. Maybe it was a year or two ago. He went way too hard on Trainium, and he got fired for doing that. And now they're just compute and energy constraints, and that's why they kind of didn't exceed expectations as much as the Azures and Google Clouds did, because they couldn't fulfill the demand. Like their backlog is growing at 25%. Their top line's at 17 or 18%. That's a huge fumble on management. I think that's why that person was let go. But it's not a demand issue. I want to call that out. But either way, all three, the demand exceeded expectations. So there is a hot pocket right now in cloud computing. DigitalOcean is a name that I always had believed would benefit from the explosion of SMBs that we're going to see from AI agents creating these companies overnight. I can have 5 SMBs in a matter of like a week, just having an incredible AI agent create something for me. And I need it. Don't want to pay up the prices for the big 3. I'm going to go to DigitalOcean. But obviously, business spending has been put a bit anchored in a small business space due to high tariffs, high interest rate environment. But either way, I think that I saw DigitalOcean trading at 10 times EBITDA multiple. Management has called out a couple times that they expect their top line growth to end 2027 at 20% while maintaining 35% EBITDA margins. So either the street, which is guiding only 14% top line growth, does not believe what Patty's saying, the CEO, or they're just like they're overlooking this AI cloud that nobody's ever heard about. And that's where the opportunities are always found, when there's a massive disconnect from what the market's saying, this is what you're worth, and how many eyeballs are on it. I love just like risking the biscuit on those kind of names. And this is the cycle where I think they're going to go through that inflection re-rating. They beat across the board. It was one of the cleanest beats they've had in years. I've covered the stock for years, but the real signal wasn't the top line B. It was the mechanics that were underneath it. They had the highest ARR in 3 years this past quarter. That tells you everything you need to know about the momentum that's building in their cloud computing offering. It wasn't just from one segment either. It was both the core cloud and it was also the AI that contributed meaningful to that number, where the AI machine learning revenue by itself doubled 100% year over year. That shows that there is an AI story that's being had right now. And also, I think it destroys the bear case that this is just a one-legged growth story. It's not. AI is providing a renaissance for their offering. And I do think that their second bear case is net dollar retention sucks for the same. It's awful. It's been a while since it's been over 100%. I think it went from 97% to 99%. And I think it's really important to know that this net dollar retention is excluding the AI revenue. So let me say that again. AI is not included in their NDR calculation. Yet, they're still improving cohort behavior and raising their forward guidance. That tells you everything you need to know that this is going through a re-rating. It went up 30% after their earnings. What did it do the following day? It went up 6%. The follow-through days are vital to see if a move's actually valid and if there's a re-rating that's happening, especially on a 30% move on a name that just isn't highly shorted. It's just left for dead and nobody really cares about. It shows it's got the analyst's attention. So I think that DigitalOcean is one of those names where if they stick to their guidance in 2027 and they continue this momentum, I think there's going to be a massive re-rating towards like 25 to 30 times EBITDA. And I think their EBITDA right now, let me pull it up real quick, for 2027 is, wow, it is $500 million. So I think, wow, this is going to be a $15 to $20 billion company if I assign a 20 times EBITDA multiple. What's the trading out right now after this move? $3 billion. I think this could be a 5xer in the next couple of years. I really do believe so. And just because it's just so severely undervalued, AI is not just a product cycle bump, it's an indefinite behavior change. And I think that alone, combined with the fact that I think they said 10% of their business now is AI machine learning revenue correlated, and it's growing at 100% clip. Wow. And I do believe that they're building this full stack agentic AI cloud now as well, because that AI business is really picking up steam, growing fast, and the customers are buying in. They're investing in it. Gradient AI is live in Atlanta, Georgia. I think their AI, I think it has like already 14 or 15,000 agents that are created by over 6,000 customers already like live in Gradient AI. That's nearly a third of whom are like net new, I'm pretty sure, just to DigitalOcean. Like, it's accelerating. It's not just an add-on product. I think it's a full new customer acquisition channel, and I think it's directly tied to the infra base. And I also want to call out, they stole 76 customers from hyperscalers last quarter. It's not just for SMBs. Like, there is a movement right now on inference when we talk about, I know I'm like dragging this along a little, but like inference is essentially letting the small guys compete with the big dogs now. And I think that you're going to see that with AMD. They're catching a win from that. You're going to see it from a lot of these like companies who want the cheaper offering that has a similar-ish product, because inference is all quantity. It's a tax. You don't have to have the highest quality on paying the tax on AI workloads. You don't. It's just like an add-on. So you go for the cheapest offering. That's why I think this is a massive tailwind for DigitalOcean. And right now you're seeing the price act accordingly. So I don't know, what did I convince you to get back into logical? Sam, are you Sam, you're in the tech space. Like,
Yeah, what you just said, I'm like looking at the chart and I'm like, I think I blundered. It's really good.
It's a $50 stock. I think it's a $50 stock this year,
it's a
like in the
compelling
next couple
pitch.
months.
I think what I would push back on is like 100% growth sounds great on that AI side. But if it's only 10% of revenues right now, I mean, you still need a lot more growth to make it more meaningful, right? So it's still going to be like at 100%, you know what I mean? I don't know. I'd want to see it. I mean, if they continue to go at that clip, then yeah, clearly that's going to be huge.
So, I mean, my thoughts on DigitalOcean, And maybe I'm just biased because I've held a lot of like smaller mid cap companies in the portfolio, and of course larger cap or mid cap, larger size mid cap companies, and a lot of leaders as well. And I'm just so biased to owning the leader over anything. When I think of like small SMB companies that focus more on SMB versus the leaders, I think of like CrowdStrike and Sentinel-1. That's the first one that comes to mind because I've owned both. Obviously, CrowdStrike has seen a lot more upside than Sentinel-1. In fact, I would say that in the last 2 years, CrowdStrike's up basically like 300%, while Sentinel-1 is up like 10% max and has massively underperformed the market. That's because Sentinel-1 really focuses on smaller businesses, and also smaller businesses can be very volatile in terms of their clientele, in terms of revenue that they do project and everything. It gets much harder for them to guide. I'm not going to discount DigitalOcean. I obviously need to look more into this. Whenever it comes to hyperscalers, I'm always more leaning toward owning the larger sets versus the smaller ones.
But it's such a big pie, though. That's the thing. Like, even if
it is a big
5%, sub 5% is massive.
Yeah, it's like NBIS versus AWS or something, right? Like it's such a big pie to eat, and the TAM is growing very quickly, so the smaller players can make a lot of money. The risk reward is obviously the upside of DigitalOcean, and I'm not saying that I wouldn't buy right now. Like I'd have to do my due diligence to look into it. I've owned this in the past, probably like early this year, and traded it per se. Got out at the right time. Was considering getting back in the mid-20s as a trade, but I've never pulled the trigger as far as a fundamental basis. But this is definitely something you need to look into, and I really have no problem buying something after 30%.
Do it tomorrow, it's like, right now.
It's
I'm
like
gonna bully you into it.
It's like Palpatine, like do it. But
Patty, if you're listening to this, we'd love you to have you on. I know you follow me. I should probably DM you. Like
that'd be awesome.
I'm a big believer. Yeah, we should all swim in the pond that you're working on right now.
Oh yeah, that'd be really cool. I mean, you're really coming head to head with a lot of the hyperscalers out there, and I don't know if it's going to happen, but it could be open acquisition at this point, like $3-4 billion company, and then you especially have these larger companies at big valuations that could potentially be the acquisitor, whatever the hell it's called. Like what's the name of the person that acquires the acquirer? Yeah. We were talking about this before and we were speculating on it. I mean, what if it would make sense if Cloudflare did? Okay, I'm sorry. I'm looking at a chart right now and Apple is just ripping to like the 220s right now based on the news that just happened recently with Trump basically saying Apple is exempt from the semiconductor tariffs and so on.
That was priced in though. Yeah. They're up 5%. Are they running after hours?
3% after hours, which brings it up to
I saw there was another piece of news. They're getting a new manufacturer.
You're talking about Corning? Corning. Yeah, they're expanding their manufacturing, not creating 40 to 50,000, but they basically support that many. They're getting a lot of positive news, but also you have like these laggards in the market that, and I was just talking about it earlier, that are going to make a comeback, right? And when you think of Apple, it's like that's obviously a very well-known brand, and it's going to make a comeback as far as the narrative goes. I don't think there's any reason why that Apple should not be going up in the market. But anyways, going back to DigitalOcean, like I definitely think they can make a comeback when it comes to that. They don't have to worry about open source software or anything. And I don't know, who knows? It would make sense if Cloudflare acquired them. I don't see why that wouldn't happen, especially if Cloudflare did sell or raise some money, by diluting some shareholders recently at their crazy valuation right now. I mean, what's $4 billion of a $74 billion company? Probably more than that today, like 76 billion. Like it could happen. I could see Matt Prince doing it. Like it makes sense, right? If you want to scale out your CDN, which is probably one of the most important things when it comes to the inference world, why not acquire all this free compute that you could use yourself?
Millions of developers they would get as well. But here's the caveat. I do want to get to the next topic, but add color. I don't think they're going to sell out because they went on an AI talent hiring spree a year or two ago before they had to pay up for it. Their CTO, CPO, his previous role, they poached him. He ran the AI division from AWS. Before that, VP of NVIDIA. And I forgot who they hired after that person. Like Patty just wanted a hiring spree. There's talent around. I don't think someone like that leaves running AI for AWS to work somewhere for 2 years and get sold. Maybe I'm a little naive, but either way, let's talk about the next hot topic. SaaS is dead. And I think that's a fun one. because I think SaaS is very dead. We talked to Bill McDermott at ServiceNow 2 weeks ago. We've talked to a couple people in that space where being a SaaS company is now having the nicest house in the worst neighborhood. Nobody wants to know that you live in the SaaS zip code, because that AI tsunami I'm talking about, it's coming for that whole space. I don't think people realize 75% of the SaaS companies will not be here publicly traded in 10 years. I think they're going to go, it's going to be a heavy cannibalization. I think we saw signs of that with Confluent, but I think it's just more than a Confluent issue. I think we're watching the SaaS stream confront a quiet reality where great products don't always translate to great businesses, especially in a world which we're in right now. The strongest products are open source, and the smartest customers are AI native. OpenAI, Confluent, we just talked about it, but it's not just a Confluent issue. Elastic, they have an incredible search product, but their managed services is disappointing. Like, everyone uses their open source search product, but they're growing in the low teens. But let's talk about Confluent first, because they just had their earnings last week. They are trading at $17. They are just getting destroyed. They have an incredible management team as well. They have a phenomenal product. I think we can all agree that streaming data is very important in the new digital economy. And Kafka is so good and so embedded and so widely understood that Fortune 500s, especially the AI native ones, are saying that, why should we pay for your managed services when we already have the talent in-house to run this ourselves by using Kafka? And OpenAI made that conclusion already. I think there's going to be more bigger clients who are going to follow suit. And that single customer, OpenAI, forced a downward revision to the back half of the year and undercut the entire cloud native consumption narrative. And now, although Confluent is still this mission critical, still foundational product via Kafka, it's in the hands of these elite technical teams, and is increasingly being treated as infrastructure to own and not rent. And I think this is really important to understand the difference. I'm curious if you guys have any thoughts.
I just wanted to, can you just like explain a little bit more about data streaming? Because
So here, do you have the technical answer to that, Sam? I'm gonna bring up a dumbified version
Okay, so
of what it is.
when you think of a database, it's data at rest, right? The tables and whatever the values are and every key value, if you think of an unstructured database, it sits in a table on a database, right? And it just sits there, and applications hit these tables and they process them and everything, but the data is just sitting in the database, right? It might be processed in an application or a script, whatever it is, but it's being put back into a static database. What Confluent does is that it's taking data that's in flight, so data that you're sending from point A to point B, but it's processing that data before it reaches its destination. So if you send over 2 + 2 over to a destination, Confluent will say equals 4 and then send 4 over to the destination, right? In a very basic sense, that's what Confluent does. That's what
communication. It does the communication layer of the data.
It's more of it got really popular because of the live ride tracking and like the credit card fraud detection,
Netflix streaming as well.
Like all the streaming like that. It became like a niche that obviously grew because it became so reliable and so well known by the big companies that everyone just essentially used it.
So how are they able to phase them out then if it's like so important? Like, how is this such an easy product to replicate?
Because they have an open source product, right? So if you think of let's say databases as well, let's say MongoDB, right? MongoDB is open source. A company can either pay MongoDB, the company, hey, I want to use your product and I don't want to host your infrastructure. I don't want to host my own infrastructure or databases and maintain them. I want to pay you and I'm just going to use your service. That is SaaS. That is software as a service. You're servicing software, not in-house. You're just paying for the software to manage it externally, right? It's kind of like your email. You use Gmail. You're not hosting a database server. You're not hosting an email server locally. You're not hosting the endpoints and creating APIs doing it. You're literally paying Gmail to hold your email for you and just use Gmail for sending email, whatever it is. Confluent's the same thing, where they're trying to push Confluent Cloud. which is basically they're managing the infrastructure, updates, upgrades, maintenance, whatever it is for you. You're just paying them for their service. Kafka open source is something that you take like an executable or zip file, you're installing an application or whatever, Kafka locally, you're managing all the infrastructure, managing all the processes, whatever it is, the upgrades and everything locally. You're literally spending your budget to pay people to manage this for you and to be the experts in configuring the entire application integrations, whatever that is. You're paying your own engineers to do it, or rather, you could pay Confluent to do it for you. That's where the benefit is. The problem is that you have big conglomerates like OpenAI, where they have $1 billion engineers who could figure all this out on their own by just forking a Kafka project for pennies on the dollar.
It's essentially that anyone and everyone can create their own lightweight versions of what Confluent's managed Confluent Cloud is, and because Kafka is such an open source product that everyone can use, that what I'm referencing, like these bigger whales, they can create 70% of what this really great expensive product can do. That 70% is usually good enough for them, and I think that's
okay. So just because we're on the topic of SaaS, and I know that like Sam and you kind of have different opinions on a lot of these names, because I'm trying to get to the meat of the conversation, which is like SaaS is dead. That's your take, Shai, but Sam, I don't think you think that. I'm kind of in the middle. I'm not sure what I believe. I feel that there's still going to be some SaaS and maybe not others, but I've always thought that software is becoming a commodity. I think it just becomes later on about the integrations, but seeing something like a Confluent get, disintermediated, it does make me, go a little bit on Shai's side the more I think about it. I mean, what are your thoughts? Because I know you like GitLab, for example. I mean, what are your thoughts there?
Okay, so GitLab is also open source, and that's the issue here, right? We're talking about GitLab Cloud, or they just call it GitLab SaaS, where they're hosting your entire infrastructure on their services, and specifically they use AWS for most of their clients. And then they offer it to people, right? That's their driving product. That's what all these companies are making higher margin on with their scalability, is to host it themselves. And since they're hosting it themselves, they can pay AWS or Azure, whatever it is. Like, hey, we have like 500 clients who are hosting stuff with, like, give us a discount, right? But if you host it yourself, you're just paying for a license. So there isn't that recurring usage cost that I know Shai is more bullish on for consumption-based companies versus license-based or SaaS-based. So the issue here with GitLab is that, well, what if people just use either GitHub, which is Microsoft offering for DevOps platform, or what if they just fork the project and just build their own, right? Which a lot of people have done. And also there's many other open source products out there, and there's many other competitive products out there. My argument with GitLab per se is that if you think of a pure play in terms of DevOps, your choices in an enterprise environment are really just GitHub or GitLab, right? Those are the two leading ones. Microsoft is very hard to compete with because they have the bundling power. But also on top of that, GitLab's metrics really show that they're doing really good, other than the fact that their net retention rates did, not the net retention rate, it was their clients under $500,000 or 5,000, I forget the exact number, did not grow as quickly as the market expected, and therefore they sold off in the last earnings. Very volatile stock, smaller cap as well, under $10 billion. But at the same time, yes, there is a bear case about it. I understand that. And I'm battling that with risk management, so with the position size. But go ahead, Shai.
No, I mean, you did a great job. I just think for SaaS being dead, you have to ask yourself what's middleware and what's a actual infrastructure, data infrastructure. And that's a really important difference, where middleware is going to get replaced. I've already heard from like the bigger fish, like these bigger companies are becoming more and more wanting to control everything in their vertical integration. Like they want to control everything in it. There is an opportunity now that AI is going to be able to offer them, that they can explore creating these competing products they weren't able to before because of cost efficiency issues, or they didn't have enough headcount to do so. But now these AI agents could help through that process. And I think that you need to own the data now, or in some sort, like have data in your ecosystem that's protected in order to really survive. Like MongoDB, I think MongoDB is a name that I just think is a valuation play. I don't know if they're going to really do well because that open source theory I had. Snowflake, 40% of the Fortune 2000 data is already stored in the ecosystem. That's a huge lever. But that's SaaS is that conversation. We can probably we circle back to that throughout the weeks, months. It's not just a one-off.
This
but,
conversation is dead.
Yeah, we do want to talk about AMD
Yeah,
though. Before we
definitely.
do, let's throw this
real quick. Sorry,
logical.
just one more thing, real quick. Just because Confluence issue has been the OpenAI. There was their customer, right? And they dropped them, right? But does GitLab have a similar risk here of that?
They don't have a
That
similar
seems to be the
risk.
issue.
They don't have concentration client risk.
They don't
So that's a
they
big
don't
deal,
edge-
right? I mean, I think that changes the calculus a bit because that's what the issue was with Confluent was they had
Confluent has always had that issue. They've had it
So there you
back in
go.
2023 where they had two clients that one of them was dropping them, the other was deciding getting off. That was 40% of the revenue. That was the issue back then.
Okay.
So that posed the risk here, and it was not good.
Yes.
Well, GitLab just has a GitHub issue. That's the primary thing, and I think Microsoft's going to own a lot of the pie.
It's fine.
But
It's a $7 billion company. Anyways,
I do want to add though, Confluent is still trading at 40 times EBITDA multiple after this drop.
so you're saying short it? No, I'm just kidding.
No, I'm just saying like one customer flip a switch off, and they're still not cheap even after going down 45.
Well, that
50%.
affects their. If it's but that's a big part of their volume of revenue. That's how you get negative operating leverage at that point. The valuation actually goes up in that sense, right?
Exactly.
That's why I'm bullish GitLab, because they're not really in the same boat when it comes to that, right? Like obviously GitLab is not profitable on a GAAP basis, but like, dude, their metrics look great. Like it doesn't. Go ahead.
Here's the thing about GitLab though. Like everyone knows the AI tsunami is coming. It's the world's worst kept secret. They're gonna get acquired by Google. They're not gonna survive in 5-10 years by itself.
Yes,
no,
please.
But they're never going to get a premium multiple that they deserve because of that. You're seeing like the proven winners, stage 2 AI winners, Cloudflare, Axon, Palantir, ServiceNow. They're all maintaining their premium multiple. The rest, there's a huge distance between tier 1 and tier 2 software names on what the multiple should be. There's a reason for that. And I think it's going to continue widening. And it's from the AI tsunami, lifeboat. But again, that's enough SaaS because we got to talk AMD right now. And I think that Logical made a really interesting play that was AMD adjacent. So talk about AIP before we get into AMD.
Yeah, so AIP is Arteris. They're basically like a chip design company. And then they had this basically like a PR announcement where they're working with AMD. AMD has selected them as basically a partner to design a lot of their chips that are going to enable AI. Basically, they have like these network on chips things, which helps their infrastructure in terms of being faster at computing, more capable, etc. The stock popped 50% after hours, which was interesting, and that was getting a lot of like volume, and the stock's been looking good. And then they had their earnings report, and the stock gave back all of those gains. I'm glad I took some profits on a trim, but then I listened to the earnings call, and they basically said, yeah, so people were like, prodding and asking, hey, what's going on with, the AMD revenue? What should we expect from guidance standpoint? And they're like, oh no, that's already been baked into guidance previously. So it's like, wait, what? So that's why the stock did not hold any of those gains, because while they have like this fluffy PR, it's not really showing up in the revenue quite yet. But it's still validating the thesis. So I still like the stock. I added more back when it came back to reality. It still shows that it has a very bright future, and it can land more of these contracts as more like partners end up like vetting their technology and stuff. So anyways, I'll pass it to you guys, but that was the small news on the AMD AIP front.
Sam, is your AMD a positive or negative take? I think the negative should go first.
No, I'm bullish AMD. I just don't own the stock.
No, I meant earnings reaction.
Oh,
what's your take from the earnings?
There are a lot of expectations when a stock essentially doubles. You better show up, right? Data center didn't do as well as the street had hoped, and it got hit. If you take ALAB, for example, or Stare Labs, if they didn't hit on their analyst estimates, they'll get hit. Even if ALAB was in line, they would still get hit because they came into the earnings with a not crazy valuation, but with an elevated expectation of what the company was going to perform. People thought Lisa Su was going to come back hard this earnings. Not saying that she won't. I think AMD is going to be an amazing play for the next 5 years. That day just was not today. They did attribute a lot of the reduction in growth for a data center to the chip restrictions, but at the same time, that literally was just lifted a month ago. right? Which didn't necessarily include most of the quarter at all. Also, on top of that, there was a bit of front loading in the first quarter. And then you came into the second quarter, which the earnings was part of. You saw that hit with NVIDIA. I kind of expected the same with AMD, but I didn't expect the company to be down 11% today. I don't know exactly what it was down today, so don't quote me on that, but it was down pretty big today. I think it deserved a little bit of a shakeout from a technical perspective, but also on top of that, a little bit of reality, like, hey, this is not the leader in the biggest wave we've ever seen in technology in our entire lifetime. So let's treat it like one, right? You saw NVIDIA do the complete opposite. NVIDIA's up. I think that was basically the affirmation that Jensen Huang was like, hey, you know that meme from Captain Phillips where he's like, look at me. I'm the captain now. Well, basically Jensen Huang said that to Lisa Su, but instead of saying now, I'm still the captain, all right? I feel pretty bad for a lot of people thinking that AMD was going to pull an NVIDIA. It's not going to, I'm sorry. But let's just say gaming comes back and PC comes back, all right? AMD will see a massive tailwind if that happens. But until then, NVIDIA is still the leader.
It is back. That's the thing. I think that was the biggest hidden gem. Not hidden, but it was the biggest gem of that earnings report was CPUs and gaming GPUs are carrying the story right now. But the issue was, like what Sam was mentioning, it doubled. So the valuation was screaming AI GPU super cycle. It wasn't that narrative this cycle. It really wasn't. And we talked to Lisa actually before the earnings got announced, and we communicated that they have to be overly communicative on what the inference tailwind will be on their AI data center space. They can't just call out the AI DC. They have to specifically say what inference is doing in that section and provide more layers of everything that's happening under the hood on the data center front from AI. And I think that what's happening right now is justified for the stock price just because it's kind of got ahead of itself. It happens all the time. Like everyone thinks that AMD is going to be closing the delta with NVIDIA, but it's not trying to be the next NVIDIA. It's trying to get that sub 10% share of the AI accelerator market, which is a huge opportunity. And to AMD's credit, their execution has been world-class. Like Lisa is probably one of the best non-founder led CEOs out there, especially in something as important as what AMD does in that semiconductor space. It's one of the few companies that actually mastered chiplet-based design at scale. Intel didn't really do that. And I think that there is a world where AMD's TSM partnership is going to be at a level where it essentially becomes a co-development thing. Their roadmap aligns, inference really does scale up. The China heartburn is going to get digested. It's going to move on. But for me, like I want to see more from Instinct. I want to see Oracle type wins with hyperscaler size numbers. I want visibility in the MI350 adoption beyond what they're saying on the conference call. If AMD has the second best inference platform in the world, which I believe that they do, then that $50 billion TAM by 2030 is up for grabs, and stock might look a bit overvalued right now, but if AMD starts to prove again, like they get that sub 10% share of that AI accelerator market, I think it's going to grow into that valuation and some more. It feels like they kicked the can down the road for Q3. Like the burden of proof now shifts to Q3, and I think the stock just ran up way ahead of its like what was actually going to get communicated and delivered. It's nothing Lisa's fault. Stock moving is all based on retail, all these different dynamics. That's not whatever she was saying. So
yeah, it's not her fault at all. I think Lisa Su is one of the best CEOs on the planet. A lot of people laugh at her because of the stock price, which is just stupid. You don't blame a CEO for the way the market looks at your company. You determine a CEO based on the fundamentals of the company over years, not a quarter, not 2 quarters, not even 2 years or 3 years. Years, and she's been at the helm for a while. She turned the company. Remember, if they really want to talk about stock price, do you remember when AMD was in the 20s? What was it, like 5-7 years ago? It was in the 20s, and people thought AMD was over. Look where it is today. It's 8 times more that price, even after this pullback, right? She's a great CEO. She deserves CEO of the year. What was it, last year, 2024? But before we continue, actually, I wanted to step a bit into the medical AI space. We have on Friday, Tempest AI is reporting the Nancy Pelosi bet, which is actually pretty interesting because I'm a holder of TEM, not as big a position as I would want it to be. I want to get the opportunity to add to it, but there's also other small players in there like PSNL. Logical, do you want to talk about that one?
Yeah, and just to close that AMD convo, 2 quick comments. One, I still can't believe Lisa Su and Jensen Huang are cousins. That blows my mind. And then 2, while it was like a big dump today on AMD, dude, I just looked at the chart. It's beautiful. I mean, it held the 21 EMA, it wicked below it and held it, and it's huge volume. So people bought the dip today. Anyways, moving on to PSNL, Personalis, NTRA, who is another testing company, and then Tempest AI. So Personalis reported yesterday, NTRA reports tomorrow, and Tempest reports on Friday. These are probably the biggest players in like the AI healthcare detection test space, whatever. PSNL, really unfortunate for me because it was a decent sized position, again, like 5.5% or something. I never go too big on ideas that still have some binary risk. They missed the mark. They lowered guidance. They basically talked about how there was a decline in revenue for pharma tests and services. So I feel like that's going to be a read-through going into NTRA tomorrow and Tempest AI on Friday. Tempest AI stock has been extremely weak. Short interest has been ticking up even as the stock has been struggling. And then NTRA reports tomorrow, and Personalis has some partnership revenues with them as well. They have partnership revenues with Tempest AI as well. So it's kind of like, I'm wondering if this is a read-through. I almost want to short these stocks, seeing what happened to Personalis. I feel like some of these reports are going to be out by the time you hear this. But I mean, I'm just talking, man. I got absolutely crushed. Personalis is a small cap. It requires insurance coverage to see those volumes and to be able to see that margin expansion opportunity. Management is kind of, I don't know, like they talked it up really confidently in the last call. This call, they're still confident. They're like, we've submitted 3 things now. We expect 2, we have 3 shots on goal. We expect to get 2 coverages by the end of the year for 2 different indications. So, Personalis can turn it around. For today, I did a tax loss harvesting, and I'm selfishly hoping that, that insurance news, comes after my 30-day period when I can revisit the stock. Obviously, for patience sake, I do hope it comes as soon as possible. But I'm wondering, these other stocks, Tempest and NTRA, have been weak. And yeah, they cited basically that pharma tests, and maybe it has to do around these tariffs. I listened to the call, but it kind of felt like vague commentary there. And they just said, volumes were down. So I'd imagine they're probably not the only ones feeling that. And we'll see in the next couple of days what these other guys report. But I also dumped my Tempest position for now, just because I got, hit on this PSNL, and, I'm going to wait and see what happens. But anyways, I wanted to get those comments in just for what happened in this week. We can call it there. Yeah, it was a great show, guys.
Anything else, Shai?
Tune in next week for episode 3 of season 2.
Can we just end the earnings season now? Like, this is just crazy, man.
I know. I want sleep. I know. I want
let's
sleep.
take a break. It's like this morning I was like, oh, great. I don't really have that much reporting tomorrow. And then I saw Oscar's report. I'm like, oh, man, here we go. There's a lot more.
I woke up Tuesday morning thinking it was the weekend.
Oh, what a nightmare.
That's how exhausted Monday was.
It's really good.
4 names today, man. 4 names. I feel like, when you were in college and you had like 3 finals on the same day, that's exactly what I felt like.
Oh my goodness. Don't remind me of those days. And then you had to study for one of them. You had to put all the time into one of them. You couldn't do all of them. Anyway, guys, it was a great episode. Captured up in episode 2 of season 2. Definitely keep an eye out for episode 3 coming out next week. We have way more earnings coming out. We haven't even really crossed into the bulk of software earnings season yet. That is usually a follow-up of the major mega cap earnings season and maybe mid cap earnings season, but it's not even close to being over. And also the 5th Super Bowl of the year, or in this case, this would be the 3rd Super Bowl of the year. NVIDIA earnings is coming later this month. So that's probably going to be something of a discussion, episode 5. We'll see. But once again, guys, thank you for watching. Thank you to Futurum Equities for sponsoring this video, or producing this video as well. Appreciate you guys. See you guys in the next one. Take care.